Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Over a 15-year career at Deutsche Bank, Devin Anderson watched the pendulum of risk swing, developing solutions for clients during the ultra-low vol period before the GFC, through the crisis itself, and then again during the relatively benign periods of its aftermath. Devin has observed the tendency for modern markets to lurch from quiet to chaos. In the process, he's had a front row seat in how various hedging strategies have performed and why. We explore the poorly timed decision by Calpers to unwind its hedging program just before the pandemic-related market sell-off in 2020, a discussion through which we learn more about Devin's co-founding of Convexitas, an overlay manager working with clients to efficiently hedge risk. In Devin's view, the why of tail hedging is clear: to realize explosive gains in down markets that can be used to fund purchases of newly cheapened assets. The hedge vehicle should generate and deliver cash at the right time, and because of this, structure and implementation become important parts of the product. Next, we explore the VIX, the ubiquitous but also poorly misunderstood metric. Here, Devin differentiates between products like vanilla index options that have convexity with respect to spot prices and those, like VIX options, that are written on vol itself. Both serve important roles, but require different monetization game plans. I hope you enjoy this episode of the Alpha Exchange, my conversation with Devin Anderson. My guest today on the Alpha Exchange is Devin Anderson. He is the co-founder of Convexitas. Devin, thanks for being on the podcast today.
Thanks for having me. I'm excited to be here.
Excited to have the conversation myself. We share some similar DNA just in terms of analyzing vol and convexity and options markets. So this will be a really interesting conversation. Let's kick it off. Let's get started with you and your background. Tell us about how you got started in the industry.
Sure. It's kind of interesting. I had a career in technology where I worked as both an engineer and a salesperson in a bunch of firms during the dot-com bubble, actually a little before, starting in 1995. I helped start two internet service providers, and then I worked at a commercial internet company and a data center company, and I worked at Lycos, the search engine, for a while. And then at one of those firms, we took on a revolver from a syndicate of banks, and this is like height of the internet bubble type stuff, right? And they said, the VCs said, well, what you got to do is buy a software company. And we said, okay. So we go out and raised a revolver and bought a software company with it. We went into technical default on the revolver, and ultimately that firm was sold in structured bankruptcy court. And during that time, I made a deal with the folks. I said, hey guys, look, I mean, this is a $50 million a year company that just declared bankruptcy. Like, people are going to be running for the doors. How about I stick around, but you give me the flexibility to go to business school, over the next 2 years while we work through this bankruptcy? And they said, yeah, we'll take that deal. So I went to business school while working at a bankrupt technology company. I shouldn't describe it that way. We actually never missed a payment. It was a technical default. But I learned two lessons kind of about finance before I even ever started in finance. The first one was, if you have borrowed money from a syndicate of banks, you want to be the first to default, not the last. Because when we kept negotiating forbearance because we thought it was the right thing to do, because we could continue to service the debt. But then by the end of it, they just foreclosed on us because we were the last thing in the portfolio. It was the only good collateral. So be the first to default, not the last. The other one was, when the VCs are pounding the table to go into a kind of orthogonal business line, you need to think very carefully about that. So two real important lessons about finance and business strategy kind of right at the get-go. So I'm going to business school during all this, and I kind of fall backwards into some derivative classes because I thought maybe that would be interesting, and I was good at it. And the staff there encouraged me to talk to some banks. And then, the following summer, I'm doing an internship at Deutsche Bank. I get hired and spent 15 years there in a bunch of different roles in the equity derivatives complex. I started as a salesperson. I ran the solutions group for a period of time, which was like structured sales, basically everything but the flow desk. I was head of structuring for a period. And then in July of 2019, Deutsche Bank shut down its global equities business. And I spent 18 months in the bad bank disposing of some of parts of those businesses that weren't retained, essentially running auctions to get rid of the risk. Did that for a while, which is, I think, actually, like, if you're going to be a career sell-sider, everyone should do a rotation in the bad bank just as a matter of experience. It's a very interesting project, but probably not one you want to have as a full-time job.
I can't help but comment on the bad bank that was your closeout of DB. Sounds like a 2-year assignment. I know that the Lehman bad bank was still up and running 13 or 14 years post the bankruptcy. And I think it was the front cover of a recent Business Week edition. So that one was going for quite a long time to unwind something like that.
Bad banks don't really ever stop existing once you have one, because there ends up being stuff that is long dated that you can't get rid of, right? I mean, like, if you have any business that issues security, like, an issuer can't assign their side of that trade, right? Securities law just don't permit it. So, the job of the bad bank is basically to get all of the risk down to zero or to a negligible level, and then kind of have a staff in place to service things, coupon payments and life cycle, the things that, you actually can't legally novate or transfer. So, like, it takes a really, really long time to actually close the bad bank, but the work of de-risking, at least in equity, even in a pretty big equity derivatives business like we had at Deutsche Bank, that ends up not being a 10 plus year project.
Let's talk about some of your time at Deutsche Bank running this structuring solutions business. Tell us a little bit more about it. What were some of the maybe notable areas of research and product development that you and team were involved in? What were some of the trends in client demand? Tell us more about that.
So that solutions group, and what we called solutions at that time at Deutsche Bank, was a mix of the retail structured products business, which in the U.S., as I'm sure you understand, is about the wholesale, right? So when clients buy retail structured product in the United States from their broker, in most cases, but not all cases, are going to paint with kind of a broad brush. Everyone does it a little differently. They're not buying it. It's not as if Raymond James is issuing them the product, right? All that product is actually coming from a larger bank with a pretty big balance sheet and then runs through a distribution network. So there was a part of our solutions business was a retail structured product wholesaling business, issuing auto callables and, kind of all these whimsically named structures, the wedding cake being my favorite. And then we had an investable index business or a risk premia business where the bank is developing and packaging systematic trading strategies that are then resold, sometimes linked to structured products, sometimes via swaps. So you have risk mitigating strategies there and yield strategies and more things that I would label market access, like commodity strategies and carry and curve strategies. There was a really unique asset that still exists at Deutsche Bank called DB Select, which was a hedge fund platform that I was also responsible for in the United States. So think of it as a hedge fund on our balance sheet that we would then kind of act as an SMA agent and deliver the returns of those funds on swap out to investors. A lot of interesting advantages to getting access to certain classes of strategies that way. So it was, and then of course, all the non-flow parts of the equity derivatives business. So if you wanted to trade your rate contingent put or volatility knockout option, there was a light exotics business as well. So kind of a big complex set of stuff there that basically is everything in the equity derivatives world except flow. I would say that kind of the intellectually interesting part of that job was always the investable index business and strategy development. So we had a team of structurers and strategists working on developing things that we could sell en masse. So intraday trend was emerging as a popular strategy at that time. Variations on delta hedging, short option strategies, yield strategies, and trying to optimize those was a very popular thing that we spent a lot of time on. So marketing that, designing it, distributing it to, when you're in a bank seat, mostly to non-taxable investors or other asset managers was how we spent most of the time there.
Tell us about, you talk about your 15 years. So as we look at that span, we see almost impossibly low vol periods and then impossibly high vol periods back to all the way into something like 2017, another impossibly low vol period. So you sort of run the table there in terms of the span of the VIX going from 10 to 80.
Yeah, I joke that I've really spent my career lurching from one crisis to the next. My technology career ended in a bankruptcy at the end of the dot-com bubble. And then I was on the desk for 2.5 years, and we had the global financial crisis, and then the European sovereign debt crisis, and then, as you say, some periods of very, very low vol. Yeah, there's a lot there in that period.
What happens from a client engagement standpoint, from a product development standpoint, through these different cycles where maybe it's the need to earn carry and to stay incrementally positive just in terms of generating some yield when rates are pinned to the floor and vol is very low. And then, as you say, lurching to these episodes of crisis where you can't pay enough for hedges and you're trying to find that convexity that you would need to overlay into the portfolio. Tell us just a little bit about looking backwards from a perspective standpoint in terms of client interaction and product development.
Yeah, so I would say that there's a couple things that really stand out at a high level. The first is the financial crisis changed everything about the derivatives markets in the course of a year. So when I first started, you had a much more vibrant, long-dated volatility market with multiple players. You had kind of a much more dynamic set of trades coming from the insurance space and also using more products like variance swaps. This is because at that time, all of the variable annuity obligations were in price return S&P, not vol control indexes, right? Vol control indexes didn't even exist prior to the financial crisis. So the financial crisis comes along and it really reorders everyone's view on, the value of both long-dated derivatives as well as the whole notion of counterparty risk. I remember that year, like coming in on Sunday and ISDA tried to arrange netting sessions. I mean, the amount of gyration around trying to reduce the counterparty credit risk in the system was intense, right? And that left scars, right? I mean, it really transitioned people into more listed format, clear derivatives. The regulators have worked really hard to clear and report through SDRs, the swap activity, right? And kind of the net of all of this is that the exotics market, when I left Deutsche Bank, there was really less of an exotics market than when I started. So that's a really fundamental shift in the type of stuff that's out there. So that's kind of one bucket. Another bucket I would say is, you're dead on about the search for yield. It's still a thing. I think even now there's a lot of miscalculation about how much shortfall is actually out there because it's not necessarily observable to sell-side banks. But this usage of derivatives for yield and then trying to manage that risk was much more important after the financial crisis and up until now. I mean, I remember when I first started in the business, it was a bit of a stigma to be a shortfall guy, right? People would say about a manager, oh, well, they're just selling options, right? Well, then selling options became a legitimate strategy. And now, with a couple high profile failures, pendulum swinging back the other way, not all the way to, I think, shortfall being a stigma, but I think short vol in a reasonably risk-controlled way, or as I would say it, short vol, properly sized, is probably a little bit more in vogue now. To be clear, we don't have any short vol strategies, but it's not that I don't need to justify short vol as a strategy, but I do think it has for the record, I do think it has a place. It just has to be properly sized. And then the other big change I saw over that period was the composition of the client base and what they use options for. So when we first started, and when I started in 2005, there was a very vibrant equity long short hedge fund community that was trading, let's call it 2-week to 3-month options for direction, right? I learned options in a business school setting from some very good professors like Dwayne Seppi at Carnegie Mellon. But I kind of left business school thinking, well, you trade options for their convexities. So therefore, professional options traders must be trading all these complex, delta neutral strategies, right? But then I show up at the bank and very quickly figured out that 2/3 of the flow was directional guys taking directional views on individual names in the first 3 months, right? So a little bit of a reality check there, but that changed a lot over 15 years for sure, right? One, because the hedge fund business fundamentally changed. There's less of them, and there's certainly less active discretionary stock picking, and even less being expressed through options than when I started, for sure. So both kind of the denominator there is changing as well as the usage. And now, not that there isn't any, but the conversations I was having towards my end of my time on the flow desk were much more about risk management for asset managers and big investors rather than, the desk trying to service the needs of a lot of, directional equity long short managers. So I could probably keep going, but that's three kind of really big structural changes that I witnessed in my time at the bank.
Yeah, the evolution of as you say, the client base, and then the resulting change in the maturity profile, typically of options that are implemented. And I got my start a little bit before you, but certainly in the late 90s, it was probably a 70% retail market. There was no electronic trading. And then it really flipped. It was probably 70% institutional. And I don't know that it's flipped all the way back to retail, but certainly we know the tremendous appetite for ultra short dated options electronically traded by retail is become a thing now.
Less retail in the last year, though, that's for sure.
Yep. And the other thing you said I thought was interesting, again, just back to changes in the composition of the client base, is this long dated vol market, which is just not a thing nearly to the extent it was. It's almost, you see even a 9-month trade go up in S&P, and that's a big deal. That's a lot of Vega. So the ability to warehouse it is just not really there to the extent it was.
Yeah, and that's really a function of how much risk the bank dealing desks are wanting to take. And let's be clear, I'm not being critical. I think it's somewhat rational. Like, if you had to choose how to deploy your balance sheet and your choices are, trading 10-year S&P variance swaps, 1 million Vega at a time, like, that seems absurd now, but I promise you, like, there was a time where that was a big order, but it wasn't like get the gong out order. Okay. And, if your choices were that, or let's have a relatively automated market making business with a high touch institutional thing on the side of it, where we're mostly trying to service asset managers, and by asset managers, I don't mean hedge funds, I mean other option users. And, I think I'd rather have the second thing, right? In terms of balance sheet usage, right? It's like, why don't banks do risk arbitrage in equity indexes anymore, right? Because it ties up a lot of capital, and capital is much more expensive. So before the financial crisis, capital was kind of free. Like, you didn't spend a lot of time on a trading desk at a bank concerning yourself with balance sheet charges. And by 2012 or 13, that was a much different story.
Yeah, it's very different now. A lot of what we've talked about so far as we sort of go through the period before you co-founded your firm, we're talking a lot about just the comings and goings of these financial cycles, what they mean for vol. And here's where I wanted to kind of frame the conversation we have about Convexitas and what you guys are delivering to clients. I wanted to start here, which is the pandemic, another 80 VIX event, 83, a new all-time high in the VIX. And one of the very interesting things that came out of this, really the incredible surge in equity volatility, was this story around Calpers, where Calpers had engaged a couple of tail managers, one of which was Universa, one was Longtail Alpha. And Calpers had essentially fired Universa 2 months before the big blow up in the VIX in March of 2020. And so there was a lot of debate through this, just around, well, wow, that was really mistimed by Calpers, but how could they have stayed effectively long convexity during these very lean periods for vol that we saw in 2017? Maybe not as much in 2018, but 2019 was a reasonably low vol period. And so here's the question. And just as you look back on your time in markets, this idea around owning volatility, it's got these very quiet periods where it doesn't pay for long periods of time. It can tend to pay you back very quickly if you're in the right points of the curve and you're long the right kind of volatility, but certainly can be very difficult to carry. Reflect on that a little bit for us. Just tell us, just as you look at the balance between owning vol and paying the theta, and then enjoying the benefits of being long some version of convexity. How do you strike that balance in the lean periods versus the, getting paid back for it?
A lot of the product out there is the opportunity set is just constrained by the distribution mechanism. So if I'm running a fund and that fund has to be funded, someone's going to write me a check for their allocation to me, and it's a tail allocation, that check isn't likely to be bigger than 2% of assets, something like that, if it's even that much, which means that I have to return as a manager, 3,000, 10,000, 30,000% in order to be meaningful on a portfolio level. If I'm going to put, that 2%, actually maybe a little less if I put that 2% number in the denominator, certainly those numbers if we're going to calculate returns from the collateral required rather than some asset measure. So I've got to return these huge numbers, right, in order to be meaningful at the portfolio level. Well, all you can really do to achieve that is go out and buy way out of the money low delta options that have no spot sensitivity. Well, that's one design decision, right? It's a design decision that's driven by the distribution format and the operational sophistication of the manager. But we don't have to sign up for that. There's other ways to do it. What we do, trying to balance the amount of spot convexity and vol convexity that we run in an SMA format is, wildly different than the options before the Calpers. And, that's kind of why we did it. We have a much different opportunity set in front of us and we can go out and run the risk that we think fits the regime. And for the last near decade, this is not a regime of vol expansion. In fact, we've got a note on our website and a chart that shows, the market was down at one point almost 16%. And, there's no meaningful vol expansion at all. Now that's a function of a lot of things. I think there's technical things that drive that. I think that there's very important sentiment things that drive that. But at the end of the day, being long vol expansion, being long that vega, that implied volatility, it hasn't just not paid off in this sell-off. If you go back and look, it really hasn't paid off in a meaningful way since the financial crisis. A little bit around the sovereign debt crisis and 4 or 5 days in the COVID sell-off, but it reverted. If you monetize that one, hats off, right? But it would have been really hard. So these design, kind of bringing it back to your original question in Calpers, I don't fault them for unwinding, right? I think they made a fairly rational allocation decision with the options in front of them. Their timing was unfortunate, but I don't see how we can hold them responsible for being in the market timing business. But, an important part of the founding of our firm is that we're taking a much different approach to the design of these products, trying to access a different opportunity set. And also we're trying to make a product that is tax aware and makes sense for taxable investors, which a lot of these products born from the institutional world don't really have those features. I mean, that's kind of a whole nother dimension. That has nothing to do with Calpers, of course, but it's another big motivating factor for us.
In designing your product, you're certainly looking backwards and having the experience of watching the implementation by clients or other institutional investors and seeing opportunities for improvement. So I'm interested to learn a little bit more about that. And then alongside that, I'm curious around the different regimes that maybe markets go through. So you talked about this idea that while we've had some episodes of vol, there haven't really been these big vol expansion periods. The second part of the question is just around how you're implementing the product these days versus how you would have implemented it in a previous period? I always use 2017 as this incredibly low vol period where the VIX was stuck, averaged 11 for the year. Would the approach have differed meaningfully in that incredibly low risk premium period of 2017 versus now?
Yeah, 2017, it would have been hard to carry convexity with respect to anything, spot, vol, or otherwise. If you're really committed, if you're committed to running a risk mitigating strategy and you gave up and your risk mitigating strategy cost you 4% in 2017 for up a net of 16 in order that, so that you can sleep at night and it saves you in all the other years, I'm going to argue that's still worth it. I also want to make this point. The real key to risk mitigation, people focus on, what is its performance in the event, and that's of course important. But the real key to maximizing long-term value isn't that you've got this thing that dumps out value when the market sells off. It's what comes next, right? And what you do with those proceeds. So the long-term value, the name of the game here is to acquire more assets along the path, okay? If a manager gives you a strategy and it produces value in a drawdown, you need to be able to take that value and go buy stuff with it. The compounding effect of good reinvestment from one of these strategies is actually where, I think as much as 75% of the value long-term really comes from. So if we show people an illustration that says, if you just take the targeted returns from our strategy and you kind of blindly dump it back into the market at the end of the month. I mean, it's kind of a silly illustration, but it makes the point. That's a far more convex line than if we just sum up the value of what we provide in the market's return. I mean, of course, right? But it's a very simple lesson that I think gets lost in these discussions about risk mitigating strategies. But it also implies that the strategy has to allow you to access that value. So it's an important consideration. You've got to be able to actually get at what the strategy is producing, and you've got to be able to reinvest it. And that's going to lead to real long-term additional and incremental wealth accumulation. It's not just about the strategy kind of producing a big cash flow during an event.
So you're describing this evolution of a kind of an unwind event where certainly vol does expand to some extent, asset prices go down, and if your portfolio is empowered through strategies that you're providing to be a buyer of these newly cheapened assets, that's going to add long-term return. Here's where I wanted to go with this, just in terms of the way in which vol behaves during these episodes of crisis, of market risk. So you get an initial shock, vol ultimately hits some high point. It's kind of an exhaustion point. More traditionally, it's maybe low 40s for the VIX. Obviously, you have these two events, the global financial crisis and the pandemic. It got to 80. But at some point, it starts to work its way down. It doesn't do so in one fell swoop. It sort of slowly inches back down. And my question is just around the strategies and around maybe avoiding continuing to own options that are still expensive and sort of getting less expensive along the way. How do you unhook the hedges to some extent, to stay vigilant, but not overpay for hedges as the crisis is starting to wane?
What I'll say is this: the harder that you push the needle towards relying on vol expansion and lots of vol convexity, the more important the monetization decision becomes, right? Because at post-event, implied volatilities tend to fall much faster than spot goes up on a proportional basis. So if the strategy that you invested in relies a lot on vol convexity, then you got to have a really clear game plan, to use your phrase, when you unhook the hedge. And probably doing it too early is a lot better than too late.
You've done some writing on the VIX complex and how misunderstood some of these trades are. And it'd be good just to get you to touch on some of your thinking and work there, just maybe differentiating VIX calls from S&P puts and some of the misunderstandings there. And then from there, I want to move to some of the work you've done on stock to bond correlation. But let's first talk about your thoughts on the VIX complex.
So, the VIX is, I think, a real double-edged sword to us in that I'm really happy that it brings so much attention to volatility, as a risk vector. But unfortunately, I think it focuses that attention on stuff that is a lot less meaningful than people ascribe it to. So let's just talk about what VIX actually is for a second before I make other statements. The VIX is what's known as the model-free vol expectation. So if you were an exchange and you wanted to launch an index, clearly designing an index that didn't require a lot of model parameterization is a good thing, right? Just being able to observe the S&P option prices, set up a fairly simple set of rules of which ones you're going to include, and then run these option prices through a formula to come up with your index number. That's a very good, transparent design. Agreed, right? The problem, though, is that particular expression of volatility ends up giving you a tremendous amount of exposure to spot. Okay, and the way to visualize that is, most of your listeners I think are going to be familiar with the idea that volatility has a skew in that the implied volatility of out of the money options, particularly on the downside, is higher than at the money options. Well, if we held that level of volatility constant, that curve constant, surface actually, and all we did was move spot, the VIX goes up. Okay. Now, the problem there is that if I only gave you the VIX number changing and I didn't give you any other information, it would be impossible for you to disentangle the change in the VIX that came from the change in vol and the change that came from the change in spot. You would need more information. Now, I'm here to tell you that, particularly in this sell-off, it's been extremely acute. But for most of the last decade, in the absence of meaningful vol expansion, most of the variance in the VIX isn't coming from changes in vol; it's coming from changes in spot. So, the problem with lots of attention, or the way that the attention gets focused on the VIX, is that people see spot down 2%, vol up, and we go, oh, well, vol's up. Well, maybe. Actually, in the last few years, probably not even likely. What you're really seeing in the VIX, in the absence of vol expansion, is a re-expression of spot, and frankly, a more expensive means of trading spot, right, than with S&P options. But that's just the VIX. So, kind of the VIX as an index that people quote, right, and talk about changes in vol. The reality is, most of the time, they're not actually describing changes in vol, they're describing changes in spot. But that's just kind of where the problems start. The VIX ecosystem is really complex. It's an unfortunate kind of irony that what makes the VIX popular is that it's transparent to calculate, and it's this level that you can have intuition for. And it's annualized, right? So like at all points on every single day of the year, you understand that 11 is low and 20 is in the middle and 35 plus is high, right? It's a level that you can have intuition for. But when we get into the things attached to, that's the spot index, which nothing is attached to. When we actually get into instruments that you can trade, none of them are related to the spot index, except at the instant of expiration on Wednesday morning. It's the only time the VIX spot index is actually equal to something that's trading, and even then it's not trading, it's a settlement calculation. So the futures represent 1 month fall, X months forward. So the future in 2 months is a measure of 1 month fall in 2 months. I've been in vol markets for over 15 years. I don't know a single person that has a view on vol of 1 month vol, 2 months forward. Okay. It's just a weird thing, right? Now, it doesn't make, I'm not saying it's useless. I'm just saying that, the actual thing that future represents is a little weird. And then you start talking about options on that month, right? And now you've got an option on 1 month vol, X months forward. Not my supposition. I know from talking to people. When someone goes out and says, well, I'm going to go buy a 2 month VIX call, they buy this call and then they look at where spot is, right? Rather than the correct relative forward for that option, which would be the future, which is a completely different level. So, and then you get into the VIX ETNs, right? The VIX ETNs aren't spot VIX. They're the accumulated P&L of a strategy of rolling the first month to the second month. So like that's extremely confusing to folks, right? They go and buy these VIX ETNs, think they're getting VIX spot. What they're actually getting is a product that if they hold it long enough, the P&L is completely dominated by the steepness of the term structure, not the level of volatility, right? So that's kind of fraught with all kinds of problems. But then to kind of go even one step further, I think if we wanted to talk about kind of professional VIX trading among vol managers, I think that most vol non-amateurs would be surprised to know that there is no mathematical link between the VIX volatility surface and the volatility surface. It does not exist. There's no arbitrage-free relationship, modelable relationship between the VIX vol surface and the S&P vol surface. There is an arbitrage-free link via one route, which is we could construct the price of a variance swap based off S&P options, and we can equate that in an arbitrage-free way to a portfolio of VIX options and futures. Okay, there's about 20 people in the entire equity derivatives market that know how to do that. And even if you know how to do it and you attempt to trade it, for the most part, they're mostly trading VIX futures against a portfolio of S&P options, and they don't even attempt to trade the portfolio of VIX options that would finish the replication. So the idea that there's a lot of value in VIX option versus S&P option relative value, in my opinion, is somewhat tenuous, right? Because we can't really connect those two things together with any relationship other than a statistical one. And maybe that's enough for a strategy. I don't know. But just the notion, like I said, that I think most people would be surprised by the idea that there's not an arbitrage-free connection between the volatility of these VIX options and the actual S&P surface. So what does all this mean? It means that in a regime of very low vol expansion or low vol of vol, the VIX does not have much value, in my view, as a trading instrument. What you're really doing is trading delta very expensively because it's more contracts, smaller size, and indirect. Now, if you really had a view on regime change and you think we're about to enter a regime of very high vol, I think we could argue about your evidence for that, but I'll at least buy that as a motivation. I've never heard anybody describe it that way. So I think it's useful as an indicator as long as you have in the back of your head that you need to separate the changes from spot from the changes in volatility, which is almost never done. So, internally, I can tell you when Zed and I talk about vol going up and down, we're not talking about the VIX. We're talking about the actual vol of options in our clients' accounts, right? So we say in some of the writing on the website, the vol that matters is the one you actually own, right? The one that actually prices the options that is in your account. That's the one that matters. And that's the one that I would encourage people to focus on if they are the consumer of some option strategy, either themselves or through a manager. And you can watch the VIX, as kind of a dirty indication of that. But I think you got to be fairly difficult. There is a place for these products. I do think there are some good kind of VIX versus VIX relative value strategies out there, but again, like I'm a little skeptical of stretching that into VIX option versus S&P option.
The vol beta is an interesting and open question, and I would just point to the vast outperformance of the VIX just from a spiking standpoint in Feb 18 versus the down move in the S&P. That'd be the VIX outperforming, the vol beta being incredibly high. And then I think you kind of pointed to it in the pandemic. Vol had gotten so expanded that there was a couple of days there at the crescendo where the S&P went down and the VIX plummeted along the way. It just the accordion had been pulled so wide. Let's talk a little bit about some of the additional thought leadership that you've provided. It's on your website, so I took a spin, and a lot of it resonated with me personally. I've certainly focused a ton on stock bond correlation and this idea that the fairy dust, so to speak, of the positive carry hedge that was duration for so long. And I think you make this point here that the biggest risk in a portfolio these days is the breakdown of this correlation. So I'd love to just hear that in your rendering, some of the work you've done there, and what does it mean for your business and for option-based strategies?
Well, I think the more important question is, what does it mean for like all of modern portfolio theory, right? I learned in business school, forget business school, I learned it as an undergraduate, like, finance investment 101, the first investments class you ever take as an undergraduate. The only free lunch out there is diversification. Like, I was taught that as a matter of fact. Well, when you actually examine the correlation of stocks and bonds, and we have that scatter plot on the website, if you'd like to find the article, the article's called Sticking With It. There's a picture of a guy pushing a boulder up a hill. And when you actually look at it, that's a monthly resolution chart on there. The relationship is like not clear at all. And in fact, Chris Cole and some other smart folks have written about this as well. When you look at really long histories of what I would call meaningful correlation periods, at least monthly, but even better quarterly or semi-annually, you go through long periods of both positive and negative correlation. And in fact, the negative bond price to option price, S&P equity price relationship that is really the fundamental bedrock of modern portfolio theory is actually the case empirically less than half the time, just a little bit less than half the time. We can argue about the exact measure, but somewhere between 45 and 50% of the time that's true. And I think that's very well understood among professional asset allocators and people that manage multi-asset portfolios for a job. It's not well understood by the wealth world and by retail investors at all. And I say that from the experience of talking to a lot of them. So first, we just have to start there. Like, it's only true about half the time, maybe a little less than half the time. Then the second thing that's taken as fact about the relationships between bond and stock prices is that you're much more likely for that negative relationship to turn positive and destroy your portfolio diversification value when inflation is high, right? And people point to the 70s as the late 70s as an example of that. Well, turns out that it is true, but it's not a black and white thing like it's kind of portrayed to be. So you find, again on that chart, you find plenty of instances of both positive and negative relationships between stock and bond prices in both high inflation and low inflation. So I think that when you look at the data, it's actually really difficult to say with a lot of certainty about even what regime you're in or what is going to work. But I will say this. So as of the time we wrote that, something like I'm just doing this from memory, like 4 of the 12 most extreme positive monthly relationships between stock and bond prices, aka the times when diversification isn't working, a disproportionate number of those have been in the last year or in the last 2 years, I think, because we're talking about monthly data. Well, it's probably not a coincidence that is a period of high inflation. And while we can't say with table pounding certainty that this relationship gets really upside down when inflation is high, it does seem to be correlated with it. And we've got a bunch of recent data that suggests that this time around, those relationships are going the other way. And then just from we're also at the point of reversing monetary policy, right? And unfortunately, the reversal of monetary policy has coincided with a pandemic, which threw a bunch of fiscal stimulus into the mix, kind of at exactly the wrong time that you would want to do it from just purely a monetary policy standpoint. So Inflation's high. We need to raise rates. And now you've got, what we think is a pretty fairly substantial portfolio construction problem because you don't really know where to go to get your diversification. And risk mitigating strategies that don't have a lot of basis risk is one of the potential answers. The other obvious answer is either commodity beta or commodity trend type strategies. So not cross-sectional trend, but kind of unconstrained trend strategies. That's the other obvious area that might help in this period. So our point is simply, we're not really here to make a call on the correlation of stocks and bonds. But it seems to us like the risk is certainly pointed in the direction of it being a real problem, portfolio construction standpoint. And as we look across the more extreme months, we've had a bunch of them recently that would tend to corroborate that. So this is a risk you ought to think of and that you ought to start to consider. The risk that your bonds are not going to be the ballast that you kind of learn that they would be as an undergraduate.
If you're in the S&P 500 options market, it's a pretty well-governed surface, to be sure. Maybe not the long-dated part to the extent that it used to be, but certainly in those front several months, you've got a pretty good read across both time and strike.
The market works in the S&P because there's a lot of diversified players who all use the options for different reasons, right? And that's what makes a high quality liquid market. One of the cool things about working in equity derivatives, I used to tell undergraduates, is this is one of the few products where every type of investor uses it all for different reasons. And from insurance to sovereign wealth to asset managers to retail to hedge funds, they're all in equity options. Some for statutory reasons, some for discretionary management reasons, some with systematic strategies. The S&P works because it is a diverse thing. You can't say that about too many derivative markets.
Yeah, it's a great meeting place for investors, even that traffic mostly outside of equities. Credit investors are using equity options. So there's this very two-way surface. There's a lot of information discovery there. What can you share with us in terms of how the strategies interact with both the shape of the surface and the outright level of vol?
Okay, so I'm going to answer your question, but I'm going to take a small sidestep into discretionary versus systematic first. The direct answer to your question is we have a specialized version of investment risk limits with our clients that we call guardrails that help guide these decisions. So when a client signs up with us, we agree to a size. That product has a set of guardrails that basically says, these are the risks that you have to have on, and these are the limits to those risks. But there's some pretty wide bands about how we get there, right? So we don't prescribe the specific options. We just put boundaries around the amount of convexity and essential shock scenarios that we have to have. The way that we actually meet those guardrails is up to us. And that's the discretion that we take as a manager. And we think that's important because the reality is that derivative market microstructure changes much faster than cash market microstructure. And what I mean by that is if we were to devise a systematic strategy in the cash world, like a factor strategy, those are likely to have a much longer shelf life because the seat of the underlying market microstructure, the players, the regime, those things tend to shift a little slower in the cash world than they do in the derivative world, because they are not convex. So when you look at kind of the life cycle of systematic products, people come up with something, and I used to do this. I mean, this is what we did in the investable index business. And it's why the investable index business is really hard to design your own strategies. You come up with some strategy, you come up with a back test, right? We don't even need to talk about back tests. I mean, it's so well covered kind of in the podcast space, like no one's ever been shown a bad one. I get it. But so you're going to come up with a back test, and then you're going to run the strategy live, probably for 3 years before people really start to take it seriously. But you know what? It turns out that a lot of the time, derivative market microstructure is changing in about 3 to 5 year intervals, right? So right about the time that your strategy has developed enough track record that you can really go out and market it and the institutional world will take it seriously is going to be about the time when the microstructure changes, right? So as a first principle position, we just believe that you have to have discretion to make the right decisions. and to be able to adapt to the regime in front of you. Like I think Zed and I certainly like to talk about markets and attempt to explain why things are happening the way that they are. I think right now this chasm between the actual economics and equity performance and the sentiment out there is a fascinating thing and contributing to the lack of vol expansion. But to some extent, it might be weird people to hear me say this, to some extent, our theory about why that's happening is less important than the trading opportunity being presented to us, right? We have to have good fundamental reasons for the strategies that we have, but those fundamental reasons need to be rooted in the flows and biases of derivative markets, which they are. All good option trading has to start from biases. Otherwise, you're trading options for their terminal payout, which is never long-term profitable. So we have those things, right? But that's one part of our fundamental thesis. But the actual macro part, while interesting, and I think it informs our discretion, it isn't the final thing. So now I'm going to come back to your original question is, how do you deal with term structure changes and the actual risk? And the answer is we have risk limits that there's a minimum amount of convexity we have to have, and there's a maximum amount of convexity we have. And based on the trading environment and the signals that we're getting from the market, we exercise our discretion to implement those. And it's not always going to be the same. It's always going to rhyme with kind of our base positioning, but we're going to change it on a discretionary basis. And we believe that that's the only real rational answer to providing long convexity in an ongoing format. So sometimes we're going to source gamma from very, very short dated options, and sometimes it's going to be from 3-month options, and sometimes we're going to be right at the upper risk limit that we're allowed to hold, and sometimes we're going to be against the lower bound that we're allowed to hold, and that's the value that we're adding as a manager. So the answer is, because we believe things have to be discretionary, because regime change, we're going to monitor the flows, monitor how the surface is evolving, and we believe that we're going to react faster and work within the guardrails that we've agreed with clients. So that may not be as discrete of an answer as you were looking for in terms of, as the vol surface is going back to contango, we're going to look to do X. We have a game plan. There's no doubt. I'm not going to go into the game plan in this environment. We have a plan, but the variance around that plan is important. And we think we have to have enough flexibility to make those discretionary decisions.
Of course. So as we close out the conversation, and I want to thank you for taking the time, what are you guys excited about as you sort of think about the expansion of your business in terms of the research that you're doing from a product development standpoint? What are the things that you're spending time on and excited about looking forward?
Sure. So what I find and what Zed finds exciting about our approach to doing derivatives management in this way is that we're all SMA based. We can work on, at this point, any of the major U.S. custodians, and we're able to run these strategies in kind of never be heard before small account sizes. I mean, maybe not never, but true discretionary management at minimums far below you would find in a fund context. And on top of it, we're adding a level of tax awareness that we do believe really hasn't been seen before. So the idea of being able to take good quality discretionary management and deliver it through an advisor. We would deliver it directly to family offices and larger investors as well. But the additional ability of being able to deliver it through an advisor at a low account minimum and having technology to keep positions and run risk and reconciliations and P&L and reporting and all the things that you have to do. And to be able to do that with the complexity of the low minimum with a lot of accounts, and be smart about taxes and integrate well with advisors' other tax strategies and even add to them in some cases. That's really, really unique and something that advisors find exciting. And we believe we can add a really unique capability for the right type of advisor in the wealth channel. In the family office and direct space, there's plenty of folks out there that feel like they need a risk mitigating strategy and are struggling to kind of navigate that space. And I think we have a very, I don't think I know, we have a very different answer there than the existing tail risk community. And we're excited to tell people about that, and it's beginning to resonate.
Outstanding. Well, thanks again. It's been a pleasure to catch up with you and learn more about both your background, but also I think some of the unique ways in which you and Zed are approaching this concept of risk mitigation. So thanks again, Devin.
Thanks so much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.